Andrew, welcome to the show. Thanks for being here.
Hey, thanks for having me, guys.
Now, you were recommended to us as a guest by Chris DeMuth, with whom we had a wonderful conversation, by the way. It was really, really exciting and interesting. Lots of great ideas. And you guys work at Rangeley Capital together, correct? Right.
That's right.
Maybe since you're a new guest to our listeners, maybe we should just start with a little bit of background and what you do at Rangeley and sort of how you got there, maybe a little bit.
Yeah. So look, Chris came on, so I don't know if you guys want the full background of Rangeley or everything. I guess I can say I started my journey at Rangeley in late 2015. I came aboard as the head of research and a portfolio manager. Before that, I was involved in private credit, which all of a sudden is the hottest thing in the world. Private credit, private equity, consulting. So that was my background. Joined as the head of research and portfolio manager here. Chris, I've been working together. I guess it's coming up on 10 years now. Chris has a regulatory and merger arbitrage background, and that's a lot of his focus. With my background, a lot of my focus more is on special situations and kind of value investing. But I guess that's the overview. I'm happy to dive into any piece of it or take the conversation wherever you guys want to go.
Well, value is near and dear to our hearts. Are you one of these guys who was like, 10 years old buying his first stock?
Pretty close. That is pretty close, actually. Actually, my story, I don't know where we're going to go. My story is when I was like 14 or 15, my grandparents gave me they had bought a savings bond when I was a baby, and they gave it to me, and it was worth about $1,000, which is big money now. It was definitely big money then to a 13 or 14-year-old. It was really responsible. My dad was a banker. He said, "Hey, you've got it. Now you're going to save and invest it." And my dad took me to a guy at Ed Jones, his broker. And he was like, "You're young. We're going to put this into growth stocks," right? So actually, this was right after the dot-com bubble burst. But he was like, you need growth stocks. You need aggressive growth. So he gave it to me. The next month, I got my statement, and my $1,000 had become $950, which that was the price. That was more than N64 games were going for at the time. I was like, what the heck? This is lost. And the guy was like, "Look, don't worry. You've got a long-term focus. It's no big deal." And I looked at the statement, and the accountant had actually gone up a little bit, but he had charged me a 5.5% fee getting into it. I was like, $50? I paid this man $50? Are you kidding me? Like that. Right. I was 13 or 14, so I was working a summer camp. I was getting paid like sub minimum wage at the summer camp. But I was like, that's a week, a month, I don't know, whatever worked. So I read Investing for Dummies, and they were like, don't pay broker fees. And that's kind of how I started, or don't pay mutual fund load fees. And that's kind of how I started researching. And, at like 16, fell in love with Warren Buffett and that. So very close. But that's the origin story of if I was a superhero. That would be my origin story. Right. Or maybe supervillain.
It just captured you. And from then on, you were passionately pursuing the investing.
That's right. I remember in college sitting in the back of classrooms, and the lecturer would be joining on, and I would be reading 10Ks and stuff. So I've been pretty passionate about it since then.
Oh, that's very cool. I love that. That's like, that's Netflix worthy. I mean,
it'd be a pretty boring Netflix show. Me sitting in the back, maybe a little,
just a quick,
montage, but
2 seconds. So I love, I'm a value guy myself and have been for too long to even think about it, exactly how long it's been. Value I always start here in the past couple of years, talking with value investors. I always have to start here. Value's been tough for the past decade, hasn't it?
Well, I think it depends. Like, the markets are a really competitive place. And I do think a lot of people say value has been tough. And what they mean is 30 years ago, if you had gone and you had bought a stock trading for 10 times earnings, you probably would have done pretty well, right? The market there weren't these computer screens, everything. You did well just buying baskets of deep value stocks. Now, if you evolved, I think there were a lot of people who, one of the things that broke me was, I remember in, I think 2015, Facebook bought Instagram for $1 billion. And there were so many people who came out and were like, this is such a bubble. I think it had 13 employees, zero revenue, $1 billion. What a waste. And that was the first time I was ever like, what are you guys talking about? Like, all my friends are on it. This is and is pre-revenue, but it's got tens of millions of users. It's taking over the world. Like, you're using the wrong metric. So I guess what I'm saying is, yes, a lot of the deep value stuff has not worked, but people who were early and who saw you know, the Amazon, Apple, Apple, you could buy at 8 times earnings as recently as 7 years ago. And if you saw the potential of the App Store and the lock-in, like, that was a killer growth stock trading at a value multiple. I just think a lot of people who decry the death of value investing, and yes, it has been hard. I'm not saying it's been easy. The Mag 7 has been lighting everywhere in this world on fire. But I think people who decry the death of value investing, what they're actually saying is the market's got a lot more competitive. 50 years ago, we could go buy nets. 100 years ago, when Ben Graham was writing, you could go buy companies for less than the cash on their balance sheet. That's all gone. That's been picked over by quantitative screeners, computers that do that better. You have to evolve. And I do think people who, now maybe you got lucky with big tech and everything, but people who evolved and were willing to look at newer things and think about value outside of pure quantitative metrics, I think have done pretty well.
Yeah, I had to do a bit of evolving myself, and I found though, as in the case of Warren Buffett, not that I'm a Warren Buffett or by any means, I'm not suggesting that, but as in the case of Buffett, it was a pretty natural thing, isn't it, for a lot of value guys to start out with nets and all kinds of cigar butt type things, and then eventually get tired of the churn of it, the sheer churn of it, and maybe even run out of ideas at the top of a bubble or something, and switch over to this focus on great, what Buffett calls great businesses, right? He wants a great business that he never has to sell. And I find, and I've done that too, and I find a lot of people and a lot of folks that work with me at Stansberry and a lot of folks who are in the sort of value investing camp have sort of tended to go that way as well. It sounds like you may have made a similar evolution from what you described.
Well, I don't know. I still am really attracted to companies with harder assets, balance sheets. Banks below book value after Silicon Valley went bust was a big
Mm-hmm.
play for me, and I wish I had stuck with it because all of a sudden, like,
I know.
the banks that I bought below book and sold around book earlier this year, all of a sudden, all of them were trading for like 1.8 times book. I'm like, damn, it's pretty nice. I do hear you on nets. I mean, I think there's two things. A lot of investors graduate out of that because, again, 100 years ago, Ben Graham's writing these things. There are the America's largest grocery store is trading below net value. That just doesn't happen anymore, right? Unless you're in extreme distress in the overall stock market. So size graduates a lot of people out of them. And then I do think, again, it comes back to a net is a very simple balance sheet calculation, right? You and I could go find net in 30 seconds if somebody pointed us in the right direction. We pull up the 10K or 10Q, we do some math, and we say, yes, this is net. That's gotten generally picked over by computers that do it faster, better than you, put on a huge basket of them, run factor models behind it. The nets that I'm generally aware of today, and I write a blog, yetanothevalueblog.com. At the start, it was always focused on smaller companies. You can see nets, because they're so picked over. Most of them now are a lot. Some of them are, hey, there's questions of if it's a real business or not. Like, I remember 5 or 6 years ago, a lot of the nets that you would screen would be Chinese reverse mergers, where it was pretty clear that it said it had $100 million of cash on the balance sheet, and it was pretty clear that wasn't the case. But I just think the net pool is a lot smaller. It's gotten picked over by quantitative. So I think investors have had to gravitate towards
What do
other
you think
things.
of like SPACs trading below $10? Is that something that you can get interested in?
Yeah, it's funny you mentioned that. So in 2021, before SPACs really took off, Chris and I have always been interested in SPACs. And then they took off, and we had some of our biggest winners. And it's funny you mentioned SPACs because after 2021, we were both kind of like, look, this market is dead. No, every deal, you have to have some deals that get money over. None of the deals can even get money over the finish line. I'm not sure why anyone would do it. Recently, I've been kind of interested in SPACs again.
Yeah.
On the heels, a so many of them have gone. Like the remaining ones have, for the most part, real sponsors that have had a history of getting them over the finish line. I love the up down on SPACs where you buy it, as you said, at or below trust. If they get a deal that really works, then the SPAC can go crazy. And if they don't, you kind of get treasury likes returns. That's incredible up
Yeah.
down to me. And then the other reason I kind of started getting interested again in them recently is, what really made SPACs go crazy in 21, 22 was they were taking, speculative growth stocks public, and everyone was announcing and they were going crazy. We haven't seen that happen with SPACs yet, but we are seeing a lot of speculative growth stocks go really crazy, as you and I are talking here November 21st, right? And I could just see a way. I don't think all these SPACs are trading at or below trust. And if you're a smart SPAC manager, I could see a wave of SPACs doing crypto plays, AI plays, and power plays in some way, shape, or form. And if the market takes, I could see SPACs going crazy again. And I really like that risk reward where, hey, the market's completely shut out. One of the things that broke SPACs in 2021 is all of a sudden there were 500 SPACs out there. We'd never seen that many SPACs before. We're down to, a normal 30 or 40 SPACs. There's still some lingering from there, but you've got a normal bunch of SPACs. And I think the market is clearly saying, we want more crypto AI companies. And if you're, the gold tier companies in crypto and AI are going to come public, but a silver tier company might say, hey, we got to strike while the moment's hot. And I think a SPAC makes a really attractive play for that. So I think you are, I don't know if you knew you were leading the witness or not, but yeah, I think SPACs are really, really interesting right now. And look, if anybody's got a SPAC they like or something, I try to look at all these, but I'd love to swap thoughts. They can shoot me a note and I'll look at any pre-deal SPAC trading at or below
so the
trust.
other question then becomes, what about busted D-SPACs? A D-SPAC being, a SPAC that's done the deal, they bought the business, and now, as you know, so many of them from 2021 are down 50, 60, 80, 90%. I mean, they've been just decimated. Is that worth sort of rifling through those names, in your opinion?
I think the answer is yes. The taint of SPACs is long. If you are a company that went public through a SPAC, most investors are not looking at you. And I think you've seen a lot of companies that they trade off so hard that they're just clearly below fundamental value. And you've seen a lot of these tainted D-SPACs get acquired for huge premiums. So one I looked at over the summer, and I'm kicking myself because I kind of almost got there and like missed a few limit orders, was ShareCare, which their stock was trading. And this is closed, so I don't have to disclose or anything, but all listeners know penny stocks and everything carry heightened risk and do your own work and all that. This was trading in the 60 to 80 cents per share. Management was out here screaming, hey, our intrinsic value or some of the parts way higher, we're running a process. And they ended up getting taken out for $1.40. So it was basically almost 100% premium to the closing price. And it had traded around that 60, 80 cents for 5-6 months while they were running a strategic process and screaming our fundamental values higher. That's one example, but we've seen plenty of examples. A lot of these private equity backed D-SPACs, the private equity firm still owns 60%. The stock goes from 10 to 2, and they look at it and say, hey, let's take it, reprivate at 4, and we'll make a lot of money. So I do think D-SPACs are an interesting angle. However, a lot of these were 2021 companies. So you've got to turn through a lot of rocks, and you're going to find a couple of princes, but you're probably going to find a lot of frogs as well, because a lot of those businesses did not have much of a plan.
Absolutely.
When they came
it's
public.
1 gram per ton. It's a mining operation, right? It's 1 gram
I
of
like
gold
that.
per ton of earth. So let's, Chris actually, he threw some names and ideas and stuff at us, and we do like to do both things. We like to give our readers a fish, but we also like to teach them a little bit about how to fish. And Chris gave us his version of that. Let's start with how you fish. Do you have a particular?
Well, what fish did Chris toss your way?
Let's see, what they were, banks, I think.
There were some banks
Yep.
banks at the time. Some of the regional banks, I think.
Okay.
This was maybe 6 months ago, I think.
Okay.
And they were,
it's I'm curious when you bring up AI, crypto, energy. I mean, those are obviously a lot of people are talking about those areas right now. And so maybe there's an example in there where there's something that is is good, and although also reasons for caution in those areas.
Look, I wish I was YOLO long AI, crypto, and energy and baseload energy from the start of the year. Unfortunately, I really was not. I had a few small plays, but I really was not. I guess Dan was saying, how do you fish? I tend to fish in quirkier ponds, spinoffs, post bankruptcies, hairy merger arb, hairy take privates. Those are all right up my alley. I guess I did have two earlier this year, which one I'm still involved, but nowhere close to the same size, unfortunately, and one I'm no longer involved. I can walk you through, but again, my interest in them is lower. So that are along those lines, but I think they'll be nice for your listeners. So the first would be Core Scientific. The ticker there is CORZ. And I'll disclose I am still long, but again, in much smaller size than I used to be. And it was for years, it's been the largest Bitcoin miner in the world. They went bankrupt during the 2022, crypto winter. Their balance sheet, they got kind of hammered on a bunch of different angles. They went bankrupt, and they emerged from bankruptcy in January of this year. And my thought at the time was twofold. If you looked at, I thought they had the best assets of all the Bitcoin miners, which wasn't saying a ton. I don't have a lot of. I think a lot of the Bitcoin miners have very poor assets, but I thought they had the best assets. They were by far the cheapest, so you had the best assets and the best assets and the lowest multiple. And the reason for that was they were emerging from bankruptcy, right? So they emerged, and a lot of debt holders, they got some equity, and they were distressed debt holders. They wanted to pound the stock as soon as they got out. You had people who'd ridden this through bankruptcy for two years. You had creditors who were getting stock. So I thought you had this really nice angle where you had the best assets and the cheapest multiple. So I bought it then. And the other thought I had in January and February when I was putting this on was they at the time had a small AI play. And the thing with AI is an absolute energy hog, right? AI does not want 10 megawatts of data or 5. They want these huge 100 megawatt plants plus. And there just aren't a lot of those out there. Now, Bitcoin mining is very energy intensive. So Bitcoin mining kind of through a lot of luck, a lot of these players have stumbled into, hey, our sites required primo access to data. It required fiber internet so that we could be connected to the internet while we're mining. The site that we built for Bitcoin mining, a lot of them have turned out, or they think they will turn into perfect AI plays. And Core Scientific, again, because this is the nice thing about buying the player with the best assets, a lot of Bitcoin miners have said, we would like to do AI. Core Scientific, to my knowledge, is the only one who has really signed like full-fledged AI deals. And in May, they announced a deal with CoreWeave where they were going to sell 100 megawatts of data, and it morphed into about 500 megawatts for a huge premium. And if you look at kind of what a Bitcoin miner trades at to what a AI data center trades at, it was an enormous uplift. So I was there for, the reason I'm not there, unfortunately, anymore is I was there for a cheap Bitcoin mining play, trading what I thought was below the replacement cost of the assets. And you can look at the stocks chart, it's like a 4 to 5x.
Nice.
It's morphed into this is pure AI backbone. But that's the type of quirky situation that I'm generally interested in. And that would probably morph nicely into the next one, but I'll just pause there if you guys want to talk at all about Core Scientific. I can talk endlessly about the Bitcoin miners if you're interested, but however you want to go.
Bitcoin. You said most of them have poor assets, but this one was okay. What assets are? Why don't you like them? What's poor about them?
Yeah. So when I think of a Bitcoin miner, the overall structure of Bitcoin mining, this is my personal opinion. I don't think you could design a worse structure. So Bitcoin mining is basically you buy power, you run it through GPUs to verify the blockchain, and you get paid out on Bitcoin. However, you don't know your cost of power up front. Now you can lock it in, but you don't know your cost of power up front. You don't know the price of Bitcoin going forward. So you're making these and you are buying the GPUs up front. So you're making these huge investments. And now that's not unheard of, right? If you think of an oil and gas company, they don't know for sure what price they're going to sell oil and gas at in the future. However, they have a reasonable range, and they probably are doing projections. The issue with Bitcoin mining is oil miners, if you and I go drill Gulf of Mexico, it's going to cost us $1 billion to set up the deep sea drilling there, but we know our price is going to be about $15 per barrel. The issue with Bitcoin mining, and that compares to, if we go to a shale play, it'll be $50. The issue with Bitcoin mining is there's no competitive advantage, right? Everyone runs the exact same. Now, you might have lower access to power, but that value is going to accrue to the power plant who's selling you cheap power. So everyone is doing the exact same thing to create the same commodity. What does that mean? When you're planning to buy and you're saying, hey, I'm going to start mining 6 months out, everyone buys based on what they think the price of Bitcoin is going to be 6 months out. That's the only edge you can have. So you have this terrible, terrible situation where everyone buys and the marginal cost is getting set by the person who is most bullish on Bitcoin, right? Every Bitcoin miner is going to invest and say, oh, I think Bitcoin's going to 100,000. I can create Bitcoin for 80,000 at my price, so I should buy this, right? It's a levered play on Bitcoin where you're having massive, massive oversupply. There's a lot of other issues with it, but that's my major issue. Complete commodity, the marginal price and marginal volume are getting set by people who are wildly, wildly bullish Bitcoin. There are other issues with it, like also Bitcoin mining. What's it really good for? I mean, there are all sorts of issues with money laundering with Bitcoin, but Bitcoin mining is the best way to launder out of totalitarian regimes, right? Because you think about it, you take power, which you're paying for in local dollars, you buy hardware, and you get Bitcoin, which you can transfer anywhere. So going back to my point, pure commodity, your marginal miner is getting built by one of two person. A person who thinks Bitcoin's going to 200,000, so they want to invest in miners because this will give them a levered way to get upsides to that Bitcoin. Or a person who doesn't care how much it costs them to mine, they're using Bitcoin to get money out of a totalitarian regime. It's just a terrible, terrible setup. There are no competitive advantages. It's the worst designed business I can imagine. Now, that's not to say that's overall. That's not to say these things don't have peaks and valleys and everything. I'm not making a commentary on the stocks or anything. I'm just saying overall, this is an industry designed to destroy value.
What's better about Core?
So what did Core Scientific have going for it? Why were its assets good?
So a lot of their peers, again, it takes huge facilities. A lot of their peers did one of two things. In order to quickly get up and mining Bitcoin, they co-located in other data centers, so they don't own their plants, right? They don't actually own the facilities, and that is terrible because you've got a facility that says, "Hey, we've got 100 megawatts. We leased it to this Bitcoin miner because 100 megawatts is a ton of power. Nobody needed it. All of a sudden, we've got demand from AI. We just kick the Bitcoin miner out and have the AI person come in, right? That's one thing that a lot of the data miners said. Or they built in really poor locations. A lot of because Bitcoin mining, you can turn it off and on, right? So you say, oh, Bitcoin's 100,000 today. I'll run all of my GPUs. Oh, Bitcoin's 20,000 today. I'm not going to run any. So a lot of them did deals with utilities where they can be curtailed and everything. That does not work for AI plays. AI needs constant access to data for a bunch of reasons. One small one, if you think of NVIDIA chips, each NVIDIA chip is tens and tens of thousands of dollars. In a data center, you might put $2 billion of chips in there. If you get curtailed for 6 hours and your chips have a 2-year useful life, like you're literally talking millions of dollars of missed costs because of this curtailment. So what Core Scientific had that these guys did not have is they owned their own facility, they owned their own access to power, and they didn't have any curtailment deals. So they could go to these AI places and say, look, a lot of Core Scientific's guys actually had background in data centers and everything. They said, look, this is not your scammy Bitcoin miner who did something to get up and running. They don't have real reliable access to power. We own these facilities. These are data center grade utilities. You come in here, obviously we'll take the Bitcoin miners out, but you're going to have a real AI facility, and that's kind of been proven out. And again, got lucky there. Look, I thought I was buying the best assets at the lowest multiple, and it turned out that I was buying not only the best assets, but AI data center worthy assets.
I see. That's interesting. So I forgot we were going to do something right after this, but I forget what it was. I want to say what else you got. I mean, that's really, to me, crypto, like a value guy, figuring out the best crypto assets is, and the AI connection is really cool. But what's the quirkiest thing? I mean, is there something right now that you think is just the quirkiest thing that nobody's paying attention to? that you think is wonderful?
Well, I think we've got to set for years. I think that I mention this all the time on the blog and anothervalueblog.com. I think the best event-driven book, best book on investing ever written is "You Can Be a Stock Market Genius" by Joel Greenblatt. Joel Greenblatt. And if I had to boil that book down to one thing, it would be incentives matter. But if you ask me for a sentence, it would be pay attention to spinoffs. And I think management teams in the late 2010s knew that investors wanted spins and would pay up for spins. And in the late 2010s, I think we had the worst set of spinoffs I've ever seen. And you saw a lot of them go bankrupt. A lot of them really underperformed. I think over the past 2-ish years, we have seen a real revival in spinoffs. We've seen some that have done incredibly well. One that everybody likes to point to is GE Veranova, which shame on me. I didn't do enough work. I wasn't long the stock, and it's been like 2.5x, 1.5x over the past year. But we've seen a lot of spins on the smaller and quirkier side that I think have been some of the best and most interesting spins we've ever seen. And if you're okay, I'll just dive into some examples, and I should note that I am long both of these. The best spinoff situation probably I've ever seen set up was Net Lease Operating Properties, NLOP. And again, I am long the stock. It got spun off from WPC about a year ago now. Are you guys aware of this, or can I walk through the story?
No, go ahead.
Yeah, please.
Yeah. So a lot of these giant real estate companies, they owned, in the early 2010s, office buildings were a great property to own. Well, post COVID, nobody wants to own office buildings. So you have these huge triple net lease companies that are getting asked, if they own $1 billion of assets, $10 million are these office properties, and 85% of the questions they're getting asked are, how are your office buildings doing, and all that sort of stuff. So you've seen a lot of these big companies spin off their office properties just so that, it's get them out. And this is a 2 - 1 = 3 situation, right? So last year, WPC said, hey, we've got this garbage barge of office buildings. We're going to spin them out. And the reason this spin was so interesting is they spun, and if memory serves, for every $100 worth of WPC shares you owned, you would get about $6 of net lease operating property shares. So they spun it off. Every WPC shareholder was there for WPC, this core, very stable business. Nobody wanted office properties. They spin off a very small amount, instantly kicked from every index, everything. It's a taxable spin. So you wake up and you say, oh, I'm going to have to pay taxes on this thing next year. It's not what I want. It's not paying a dividend. It's not stable. It's this office thing. So book value of the thing, and I think where it was indicated in when issued trading, was about $45 per share. It spins off, and the next day it hits $12 per share. And unfortunately, I didn't buy it right then, but I kind of got involved earlier this year in the high teens, low 20s. And again, book value is $45 per share. They're very consistent. They're saying they're going to liquidate this whole thing. And I think what's really interesting from a value investor's perspective is they give you details on every property that they own, every office building they own, who the tenant is, what the terms of the lease are, how long the lease is. And when you go and you just do the math on their leases, the cash flow from these leases, it's very, very difficult to come up with a per share price that, yes, if you assume the office buildings are all complete zeros at the end, yes, but if you assume, they're releasing and they're going to get, half the buildings won't release and half the buildings will release for 50% of what they're doing. And you can get a lot more information if you go and start Googling and looking at all these specific properties. But if you do that math, it's very hard to think that this stock is not worth, in a very draconian case, $25 to $26 per share. If you start giving them any credit for releasing everything, it's very easy to get a stock price in the 40 plus share on an NPV range. The stock is still trading kind of at 30. So you've got this, the spin has done great. It's been awesome. But because it's the small, quirky spin office buildings, the initial shareholders didn't want it. Nobody looks at it now because it's small, it's quirky, it's liquidating. But I think there's a huge margin of safety in that. So that's one I really like. And I think it's, if you think you have dividend-focused stability investors who get this small taxable spin-off of something no one wants, I think it was one of the best setups for a spin I've ever seen. I've got one more I'll run by you, but I can pause there and talk about net lease operating properties.
It's interesting. You're really excited about
Yeah.
it at 30-ish, 31 as I speak. And yet you're saying, like, when you say the draconian, $25 a share scenario, you don't expect that, in other words.
No, I'm saying, like, they've got so much cash flow signed with these tenants that will come in over the next 5 to 7 years. Like, if you're really just giving them credit for that cash flow, that contractual cash flow, because office buildings, these are Class B office towers. Some of them are 2 stories, some of them 4 stories, but they are contractually leased on a triple net lease. If you just give them credit for that cash flow, at this point, it would be very difficult to get lower than a mid 20s number. So if you're starting to give them any credit for, these buildings having any types of terminal value, and I'm being a little fast and loose with it, but if you start giving them any credit for these buildings having any terminal value, it's very easy to get a value higher than today's price. And again, I'm also NPVing all of these cash flows. So these are office buildings. They get checks in the mail every month from their tenants. Over the past year, basically all of their cash flows from selling properties and getting from their tenants has gone. They took out a lot of mortgages when they were doing the spinoff. Those mortgages are almost fully paid down now, so all the cash flow is starting to really accrue to the equity.
For our listeners' sake, when
what I find
speak of
interesting here,
terminal
net
value,
lease. Sorry,
that's okay. I just want to cover this one thing before you ask your question, Corey. For our listeners' sake, when you talk about terminal value, is that like, if you sell it right now kind of value?
No, I'm saying, so, you've got one of their buildings is leased to Google, right? And I think Google actually just extended their lease for it now has 6 years left, right? So you've got 6 years of contractual payments from Google. That's about as good as you can get, right? This is triple net lease. So all the cash flow that you get, you have to pay to cover your lights and your accounts and everything, but you don't have to keep the building up or anything. I'm saying at the end of those 6 years, the building has a terminal value, right? This is not a knockdown. If you assume every building is a knockdown, there would be zero terminal value. And then you'd have to say, oh, for some reason the land has no value as well, right? But if you start giving them any credit for some of these buildings having terminal value, then you can get a stock price, well above the current price for liquidation.
Value at the end of the cash.
And again, some of the buildings, yes. So I'm saying the cash flows are the contractual ones, and that gets you a decent bit of today's share price, and then some terminal value for some of the buildings you go above.
I'm sorry, Corey, what your question?
Yeah, I was just going to say, in an example of how funny the markets work, a lot of times, net lease office properties, shares are about up 100% almost this year, and the company it's spun out from, WPC, are up about 4%, which it seems. If they thought this was the bad part of the business, the part that investors weren't, that wasn't working, and you just wonder what's going on with their own business, at the same time.
Well, I like the way you frame it, but again, it spins out at the end of last year, and there's just this huge forced selling. And WPC, as you and I are talking, is a $12 billion market cap company. NLOP, as you and I are talking, is a $450 million market cap company, right? So again, this was a small piece. None of the shareholders wanted it. It was all management was getting asked about. They spun it off. And, I did something that showed the CEO of WPC. He obviously now owns shares in NLOP because it got spun off to him. The dividends he gets from WPC in 1 quarter cover more than all the salary, all the stock, everything he owns in NLOP. So all of his time, just getting this off his plate was so critical. It was so critical to them. So that's what I loved about that setup.
Forced selling is an interesting, and actually, forced selling is interesting, and even just spin-offs. You'd think that the way that NetNets and other things were kind of arbed out of being really amazing, hunting grounds, that you would be able to say the same thing about spinoffs, but not really.
Well, it's difficult because you say forced selling, right? Somebody has to be on the other side of that. And in NLOP's case, if you if you and I had been sitting here a year ago and we were like, we are so bullish NLOP, we want access to it. How do you get access to it? Well, we'd have to, if we wanted to do, let's just hypothetically say we wanted to do $1 million position in NLOP, we'd have to go buy $30 million of WPC stock in front of that to get $1 million position. We can't do that, right? So you get it, and then every shareholder who gets it sells it. We don't even know, like, you wouldn't even know ahead of time if NLOP was going to be interesting or not, right? So you have almost 100% of shareholders who want out. WPC is in a lot of REIT indices. I believe they're in the S&P 500. I could be mistaken on that. They're in one of the big S&P indices. NLOP is absolutely not. So you've got a lot of forced sellers from indexes. You get, like, that's the thing about forced selling. It's hard to say, can this get arbed away, because it's forced, and it's very difficult for, you know, a lot of event people have gone out of business over the past 10 years. And even if there were still a lot of event people, it's very difficult to absorb 100% of the float getting sold, you know, in 3 days.
I remember when we talked to Chris, for our listeners, Chris DeMuth, who works at Rangeley with our guest Andrew, he mentioned that criteria of almost 100% of the shareholders wanting out, and I found that interesting. I mean, it's a classic. I think Greenblatt even discussed it. It's a classic way to sort of look at a spinoff when, you know, they don't want it for whatever reason, you know, not in the index, et cetera, et cetera. But I found that almost 100% of the shareholders, it seemed another level of, you know, it made the hurdle a little higher for spinoffs to insist on that.
Look, for selling, again, something we love. S&P kicks something out of an index. That's generally a nice time to look at companies. You know, yeah, I guess we can talk for selling, or there's one other spin I wanted to run by you guys as well.
Oh, yeah, let's have a fish. Yeah.
Yep.
Yeah, so the other spinoff that I love, and again, I'm quite long this stock for full disclosure, is Seaport. The ticker is SEG.
Seaport, yeah.
And Seaport was spun out of Howard Hughes, which I have a much smaller position in. But Seaport is Seaport District in New York City. This was going to be, for listeners who are familiar, Howard Hughes is a collection of real estate assets. Bill Ackman, probably one of his greatest investments, was buying General Growth Properties, GGP, and basically, I believe he actually pushed them for bankruptcy, but in the global financial crisis for $1 per share, and, you know, within a couple of years, it was a 20-bagger. General Growth Properties, they own malls, but they also had all of this real estate across the U.S. They spun out Howard Hughes, and when they spun out, they owned a lot of master plan communities, MPCs. A big one is the Woodland out in Houston. But they also own the Seaport District. And this is basically, they own a block in Manhattan. It's in the FiDi. It's, you know, a 5-10 minute walk from Wall Street. They own a block in Manhattan. And in 2012, 2013, they were saying, this is our trophy property, right? We're going to spend $1 billion on this. And think about spending $1 billion and owning your own block in Manhattan. Who does that, right? So we're going to spend $1 billion, and this is going to be fantastic. You know, we think in the end game, you know, we're going to have so many great brands that want to have storefronts here and everything. And we think in the end game, we sell it to some, you know, rich sovereign wealth fund who wants to own a block in Manhattan for the rest of the time. And they'll pay like a 1% cap rate, which, remember, interest rates were almost zero, but they're like, they'll pay a 1% cap rate and we're going to make a fortune on that. It did not go well. Similar to WPC NLOP, Seaport was an absolute disaster. It was an increasingly small percentage of Howard Hughes's value, and it was pretty much all anyone was asking them about. Not all, but if you would go listen to earnings calls, you know, 50% of the time would be spent on Seaport, and 50% of the time would be spent on Howard Hughes's business, and that's a big mismatch because Seaport was probably worth 5 to 10% of Howard Hughes' overall value. So last year, they said, we're going to spin off Seaport. Seaport has been, I think everyone there was willing to admit, it'd been a complete disaster. We can talk about the reasons why. But they said, we're going to spin off Seaport. And we're going to spin it off with a rights offering. And the rights offering is going to be backstopped by Bill Ackman. And if you remember Joel Greenblatt's book, You Can Be a Stock Market Genius, I actually pulled this quote out in a write-up I did on the blog. He says, you should look at every spinoff. But if I could give you one piece of advice, it would be this. Stop everything you're doing and look at spinoffs with rights offerings. Now, he was referring to spinoffs that are done through a rights offering. This is a spinoff with a rights offering, so there's a slight difference. But this is the first spinoff I can remember with a rights offering backstop ever. I want to say, at least since I've been investing for at least the past 15 years. People can correct me if I'm wrong, but I can't remember any. So they spin off this, Howard Hughes shareholders at this point, they've been fed this, all of them hate Seaport. The financials are an absolute disaster. They've got the tin building, which they sunk $200 million into. They said it's going to be, forget Italy, Harrods in London. They said it's going to make that look like a clown show. They sunk $200 million into it. Tin building's been a complete disaster. It burnt, from memory, $50 million last year. A food court burnt $50 million. It's been a complete disaster. Seaport spins out with, it comes out of Howard Hughes. It's got like $180 million market cap, and then they do a rights offering. But as you and I are talking, it's got a $350 million market cap. They just did the rights offering, so they've got $150 million plus of cash on the balance sheet, and they've got this district in Manhattan that they spent $1 billion raising. Ackman owns, he did the backstop. He owns about 40% of the company. And I think they've got the right management team in place to stabilize, turn this thing around. And then if I start saying, hey, how much is owning real estate in Manhattan worth, a whole district? You're getting offered it in the stock market right now for about a net of the cash, about $200 million. I think it's worth a whole heck of a lot more. So it's not quite as clean as Enlop in terms of those guaranteed cash flows. But I think when you look at the cost in the ground, you look at the alignment, you look at the force selling, I think it's just a fantastic, fantastic setup. And I really like
I'm
it.
detecting a real estate theme here, Andrew.
Well, it's funny you say that.
Real assets.
I have thought about that.
Yeah.
I think it's because post-COVID, there are a lot of these companies, the real estate split so hard with work from home and everything post-COVID that most publicly traded real estate companies tend to be like kind of steady Eddie companies, right? And all of a sudden, a lot of these real estate companies had pieces that weren't quite as steady, that didn't fit their shareholder base, that didn't fit what was in their core skill set. And a lot of them spun off, and they spun off. I love these quirky ducks. I love this force selling, and they spun off in force selling quirky duck ways. So I have thought about that. Hey, why are you so interested? Why are your two largest position real estate spinoffs? And I think the answer is I'm kind of looking where the fish are, and that's where the most interesting, quirky stuff is.
It reminds me. I forget exactly. It was, within the last 20 years or so, I used to follow the Third Avenue funds. When Marty Whitman was in charge there, and he wound up with half his portfolio in real estate stocks at one point because he just found all this stuff, and then it all kind of ran up in the bubble or whatever. But it was like Tejon Ranch and St. Joe even, and Newhall Land and Farming. Like I stole like a bunch of these from him and recommended them in the newsletter. Of course, they did great, but you're actually pointing in a direction here that it's classic of value investors. You don't know what you're going to be concentrated in next, right? You just know the kind of situations you're attracted to. And if it's a bunch of real estate, it's a bunch of real estate. If it's a bunch of crypto, it's a bunch, whatever it is. It's sort of like, Buffett is always saying, we have no master plan. You have no master plan. You just know what's attractive to you. And that's interesting to me because a lot of people sort of do have a master plan. They always want to buy tech, and they always want to buy something that's growing like crazy. And they, so they're not looking at, oil or real estate or crypto or whatever it is. It's interesting. The inherently eclectic nature of a true value seeker has always been very interesting to me because you're saying that nothing is off limits. I mean, there's a line, if I'm not mistaken, in I'll probably have to paraphrase it, in security analysis, where he basically says, anything can be attractive at the right price. I forget the exact line. That's a pure paraphrase. And that's you, isn't it, Andrew?
Hey,
no?
Look, think about GFC, right? Lehman bonds.
Yes.
After they went bankrupt, a lot of people made money finding, that Luckin Coffee over in China, which fraudulent financial statements. But if you came in post the blow up, a lot of people did manage to find value there. I've had a lot of people pitch Silvergate bonds and prefs and equity saying, hey, yeah, it went to zero. But if you look at the holdco structure and the way, like, these are interesting bets. So look, the right price for anything can be interesting. And I think these quirkier areas of the market are, I think they're interesting, and I think they're, look, I'm sure all of us are kicking ourselves. We weren't buying Facebook in late 2022 at under $100 per share, but there are a lot of people who can do that. But the people who can look at these quirkier situations with real analysis, hopefully there is a pot of gold at the end of that rainbow, as I like to say. Hopefully that's the area where you can put a lot of work in, and your work can be rewarded.
Right. There's another set.
Right. And Chris talked about this with us a little bit, like your timeline for these, for these quirky situations. Generally, what are you looking at to like explain to our listeners just, what?
You never know. I mean, the nice thing about NLOP, one of the things that's so attractive there is they're going to liquidate that thing, right? So when you were buying it, if you were fortunate enough to be buying it for 12, you could do the math, you could see the cash flow schedule from all their things, and you could say, hey, at the end of 3 years, they're probably going to sell this whole thing down. And there's management contract structure in there that suggests they're incentivized to wrap this up within 3 years. So that was a really nice one, because you kind of say, hey, I've got a pretty tight time frame on it. Seaport, I don't know. Again, there's $1 billion of cost on the ground. I'm not saying that this thing is performing well. There's a reason it was spun off. But I do think one of the interesting things is, again, it was 5% of the assets at Howard Hughes. It was all people were talking about. And I think you have something where if you've been pitching something as a trophy asset for years, and then it becomes a disaster, and a lot of the people associated have been gone, but everyone else around it, it's kind of like, hey, that flaming bag of garbage over there, the people who were in charge are gone. I kind of don't want to put it on my plate, right? It's not critical to the company. It's a small piece of our asset value. If I take it on, it's a big headache for me. I'm mid to upper management. Like, if it goes well, I get a pat on the back. If it doesn't go well, I'm probably going to get fired, even though I'm inheriting this awful problem, right? So I do think Seaport is something where it was in a really weird space, but now it's spun off, and you've got a very incentivized management team that's taking over. And I think there are a lot of changes that they can make where they can say, hey, why are we burning $50 million per year on a food court? Like, that's insane. We're bringing that cost down, or else or else we're going to blow up the building. And I'm being hyperbolic there, right? But they're going to bring this cost down, or else they'll turn it into a McDonald's and they'll run it at break even. But you can't burn $50 million. But when you're in a big company and nobody wants to take on this flaming pile of garbage, that can happen. You have this scenario where prior management, they've invested a ton. You've got this asset that's very small, but it's a clear disaster. Now that it's spun off, you've got a new incentivized management team. They're going to make very obvious, quick changes to stem the bleeding, and then you can benefit from a Manhattan district that has $1 billion of costs into it. This is a very unique district with a lot of history, and I think the upside is enormous. And the downside, again, at this point there's no debt on the balance sheet. There's a lot of cash, and you've got real estate in Manhattan. I think the downside is quite protected, and the upside is very high.
What do you think the prospect for taking on debt is at this point?
At Seaport, I mean, eventually, if you thought about a fully leased up district, right, where things are going great here, 100% lease, they've got storefronts popping, the guarantee anytime a tenant goes out, people are just bursting the doors down to re-sign. I'm sure they would lease this up, sell it to REIT like this. A lot of the initial thoughts that they had, if it played out well, would work, but I don't think management's looking to YOLO this up until there is a lot of, maybe there's some easy lifting and then there's some heavy lifting to get this in a place where you're looking at that.
Okay. And it seems like, just grabbing a quick chart on Yahoo, it seems like it kind of hasn't really moved much.
No, so it spun off. It was, again, to the Greenblatt thing, it was very interesting where it spun off, and every share that you owned, they were doing a rights offering. For every share you owned, you had the right to buy, it was roughly 1.2 shares of stock at $25 per share. So it was this very unique spin where, it spun, it hit your account, and then they said the next day, hey, the stock is worth 26 or 27. Do you want to write, a $30 check for every $25 worth of stock you have to get more stock? So it was this very unique setup. Look, the spin happened just a couple months ago. The rights offering just finished. The management team hasn't really communicated with anyone yet. They said they're in their third quarter earnings release, which just came out a week or two ago. They said, hey, we're not hosting a call. The first time we're going to really communicate with people is when we report Q4. So, yeah, the stock, I mean, if you did the rights offering and you bought this all at 25, you're probably pretty happy with where the stock is. But,
Sure.
I think that pales in terms of the long-term potential, the cost and everything there.
All right. That sounds interesting to me. Sounds interesting because it's, it hasn't like doubled already or anything. It's still priced for incredible return. So, Andrew, we actually are near the end of our time, and it's time for me to ask my final question, which is the same question for every guest, no matter what the topic, even if it's a non-financial topic. Identical question. Chris answered it. All the guests answer it. But the question is simple. If you could just please leave our listener with a single thought today, what would you like that thought to be?
All right. So based on our conversation, I would just say incentives matter. Would be if you were like leaving, you say, hey, how does Andrew look at the world? How does Andrew invest? It's incentives matter. So I like the incentives of having insiders aligned with us. And I like the incentives of, hey, every person who is selling this stock to me, they're not doing fundamental work. They're not doing anything. I'm providing a service to them by buying this stock. They don't care what the economics of selling it are. So those were the two things. That's more what you would take away from, hey, what does Andrew think about as an investor or something? But those would be the two things.
Great answer. Thank you very much. And thanks for being here, Andrew. This was very exciting for me to sit and listen to you describe all these ideas and give us a couple of tickers and some thoughts about those. Thanks very much. And I hope we'll have you back again soon.
Hey, thank you guys so much for having me. I'm always here. Again, disclaimer, I mentioned it every time, but any stock I was long, I disclaimed it at the end. And yeah, appreciate you guys having me.
You bet.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.